Bankruptcy filings usually tell you how much a company owes. Synapse Financial Technologies filed for Chapter 11 on April 22, 2024, and its filing revealed something stranger. The company entered bankruptcy unable to fully reconcile who owned what. More than a year later, the Consumer Financial Protection Bureau alleged the company had failed to maintain adequate records of where its customers' money actually was, and failed to ensure those records matched the ledgers of the banks that held it. In between, more than 100,000 people, per court filings and public reporting, could no longer reach their own deposits. This is the story of what those records did and did not show. On April 22, 2024, Synapse Financial Technologies filed for Chapter 11 bankruptcy in the Central District of California. The petition named 4 partner banks, Evolve Bank and Trust, American Bank, AMG National Trust, and Lineage Bank, each holding a slice of the deposits generated by fintech apps running on Synapse's platform. It listed liabilities in the hundreds of millions. It did not say how much of that money was missing. It said the company could no longer determine the answer on its own. Synapse had built its business on a simple pitch. Banks are slow, fintech apps are fast, and Synapse's software could connect the two without either side rebuilding its own infrastructure. By the time of the filing, the company had roughly 100 direct fintech company relationships, serving customers who had never heard the company's name. The company had raised $51 million from venture investors, including Andreessen Horowitz, since its 2014 founding. Despite that funding, the reconciliation problems described in its own bankruptcy filings remained unresolved, and Synapse laid off most of its remaining staff in the weeks around the petition, leaving a company with a functioning product, active fintech app customers, and no employees left with the access needed to reconcile what those customers were owed. Synapse's core product was the For Benefit Of account, a single pooled account at a partner bank, legally owned by the bank, holding the combined deposits of every end user across every fintech app Synapse serviced. The bank's ledger recorded one number, the total balance. Synapse's ledger was the record that said which portion of that number belonged to which individual end user. Customers banking through apps like Yotta, Juno, and Copper. There was no independently maintained bank-level subledger capable of verifying Synapse's customer-level allocations in real time. If Synapse's numbers were wrong, the bank had no independent record to check them against. This structure is standard across the banking-as-a-service industry, and on paper it is not illegal. FDIC pass-through insurance rules allow a single bank account to cover many individual depositors, provided the records identifying each depositor's share are accurate and available. What the Consumer Financial Protection Bureau's later complaint would allege is narrower and more specific. That Synapse failed to maintain adequate records of where consumer funds were located and failed to ensure those records matched the ledgers of the banks actually holding the money. Many newer banking middleware providers, including firms such as Column, Unit, and Treasury Prime, advertise architectures built to give partner banks greater real-time visibility into customer-level records. Synapse's architecture did not provide that level of visibility. The difference was not something any end user opening an account through Yotta or Juno could see. It lived in the technical specification of who held a second copy of the truth. Every day, thousands of individual deposits, withdrawals, ACH transfers, and interbank migrations moved through Synapse's systems. As long as each transfer appeared to settle correctly on its own, a slow, compounding imbalance between a bank's ledger and Synapse's ledger could stay invisible. Visible only if someone attempted to reconcile the full history at once, rather than transaction by transaction. As early as September 2023, Evolve's own records already showed it was holding less money for end users than Synapse's records said it should be holding. A discrepancy both companies were aware of and later publicly blamed each other for. That single bank gap did not trigger a platform-wide reconciliation. The full picture across all 4 partner banks did not emerge until after the bankruptcy filing, when the banks began comparing their own balances against the sum of Synapse's individual end-user ledgers. The numbers did not match, and neither side's records could fully explain the gap on their own. In May 2024, Synapse failed to maintain Evolve Bank and Trust's access to an online dashboard showing consumer balances and transactions. and stopped providing the daily general ledger reports Evolve had relied on to track the pooled accounts. Without that access, Evolve could no longer independently confirm what its own ledger was supposed to show. On May 11, 2024, Evolve stopped processing transactions on the affected accounts and froze end-user activity. For the roughly 100 fintech apps still running on Synapse's platform, deposits, withdrawals, and transfers simply stopped. The Bankruptcy Court appointed Jelena McWilliams, the former chair of the FDIC, as Chapter 11 trustee, not to liquidate Synapse's assets in the ordinary sense, but to attempt the reconciliation the company and its banks could not complete themselves. Her status, reports to the court, describe an environment where 4 banks, dozens of fintech apps, and Synapse's own records each told a different version of who owned what. The trustees' filings state that no single party, not Synapse, not any individual bank, held a complete or independently verifiable picture of end-user balances. Reconstructing one required subpoenaing transaction records from every bank and app in the chain and rebuilding the ledger from source data months after the accounts themselves had been frozen. That reconstruction is still the mechanism by which affected end users have recovered funds. Not a single settlement, but a running series of trustee-supervised distributions tied to how completely each bank's and each app's records could be verified. Synapse's founder and chief executive, Sanket Patuk, gave sworn testimony to the court during the bankruptcy proceedings. The trustee's report notes that the shortfall had been previously reported by Mr. Patuk, a detail that places him inside the company's own account of what happened, without establishing exactly when he first understood its scale, or what he did with that understanding. That distinction matters. The record shows Patuk acknowledging the gap under oath. It does not, on its own, show a documented chain of internal warnings routed to and ignored by a board. In May 2024, shortly after her appointment, the trustee's initial reports to the court estimated a platform-wide shortfall between $65 million and $96 million. More than a year later, the Consumer Financial Protection Bureau's August 2025 complaint cited the trustee's estimate as between $60 million and $90 million, a close but not identical figure, reflecting a range that moved as reconciliation continued. That is not the same figure attached to the case's most cited number. A separate, more specific accounting, tied to Yotta customer deposits held through Evolve, put that single app's exposure at approximately $109 million, according to Evolve's own court filings. The two kinds of numbers describe different things. One is a platform-wide reconciliation gap that moved over time as more records were checked. The other is a bank-specific figure tied to a single fintech app's user base. It is easy to conflate them if the distinction isn't stated plainly. The underlying filings keep them separate. More than 100,000 people who bank through Synapse-powered apps, according to court filings and public reporting, lost access to some or all of their funds after the May 2024 freeze. Some regained full access relatively quickly, others waited far longer, depending on which of the 4 partner banks and which program their funds happened to be routed through, a distinction none of them had any way to know about when they opened the account. The CFPB's complaint focuses more narrowly. Thousands of consumers, it alleges, had no visibility into or control over how Synapse moved their money across partner banks in the first place. The declarations filed with the Bankruptcy Court describe rent payments, payroll deposits, and emergency savings caught in the same freeze. Money that existed, held at real banks that its owners simply could not reach. Yotta's own later accounting, released in November 2024, offers a different snapshot. 13,725 former customers who had lost access to deposited money, collectively $64,900,000, of which $11,800,000 had been refunded by that point. A separate figure from a different filer and a different month than Evolve's earlier figure of what it believed it owed. On June 14, 2024, the Federal Reserve and the Arkansas State Bank Department issued a cease-and-desist order against Evolve Bank and Trust, Synapse's primary banking partner, and a state-chartered member bank supervised federally by the Federal Reserve, not the Office of the Comptroller of the Currency. The order cited examination findings from August 11, 2023, August 30, 2023, and January 10, 2024, a paper trail of regulatory concern that predated the freeze by months, but that became public only after the collapse it described had already happened. The order does not mention Synapse by name in the way a viewer might expect. It addresses Evolve's own risk management and compliance practices, the same third-party oversight function that, in hindsight, had been unable to catch the ledger drift building beneath it. Evolve served program managers beyond Synapse alone, which is part of why the order speaks in terms of institution-wide risk management rather than a single relationship. The finding was general. The case that made it public was specific. What regulators and later court filings identified was not a single missing document and not a single missing sum. It was a records and reconciliation failure spread across parties who each held part of the truth and none of whom held all of it. A bank that could not independently verify its own ledger. A company whose internal accounting was the only complete record until it collapsed. And a regulatory paper trail that arrived, in full, only after the money had already stopped moving. The bankruptcy filing did not predict the shortfall. The cease-and-desist order that followed it did not prevent one either. Between them sits the period this episode has walked through. The 8 weeks when the gap between what Synapse's ledger said and what the banks could verify stopped being a technical footnote and became a bankruptcy court's problem. Strip away the filings, the trustee, the regulators, and one sentence is left standing. The bank owned the money. Synapse owned the truth about who owned it. The reconciliation Synapse's banks and trustee have spent more than a year on comes down to one structural fact. For years, a single company's internal ledger was the only complete customer allocation record behind accounts serving more than 100,000 people, and no outside institution was required to verify it in real time. The public version was a fintech infrastructure company connecting banks to apps, moving money faster and cheaper than either could alone. The reality was a records and reconciliation failure that regulators would spend months documenting only after the freeze had already happened. A paper trail arriving after the fact, not ahead of it. Synapse's failure was a ledger nobody could verify until it was too late to matter. The next case is a product nobody could verify either, except this time, the missing thing wasn't money moving through invisible pipes. It was the 700 people doing, by hand, what the company's pitch deck said a machine was doing instead. Next, on hidden liabilities. A company that raised over $450 million on the claim that its core product was built on artificial intelligence. Court filings and former employee accounts would eventually describe a workforce of engineers in India manually writing the code its investors were told a machine had already automated. Subscribe, and you'll be there when it drops.